Good morning, traders. Welcome back to the channel. Today is October 22nd, 2025, and what a day it has been in the markets. We had a fantastic session, locking in some solid profits, and I want to walk you through the entire thought process behind the key trade of the day. It's one thing to see the result, but it's another to understand the why, the analysis, the strategy, and the discipline that led to that winning decision. So, grab your coffee. Let's pull up the charts and break down exactly how we navigated the battle between gold and the dollar today. Let's start by setting the scene. Coming into the pre-market session, the main theme I was watching was the delicate dance between gold and the US dollar. We had some key economic data releases scheduled for this morning. And as you know, that always introduces a wave of potential volatility. The market sentiment was mixed. On one hand, there was underlying uncertainty that typically provides a tailwind for a safe haven asset like gold. On the other hand, the dollar was showing signs of technical strength, holding a key support level that we identified yesterday. This created a classic standoff, a scenario where you don't want to jump the gun. Patience is your best friend in a market like this. My initial bias was cautiously bullish on gold, but I needed confirmation. I wasn't going to place a trade based on a hunch. I needed the market to show me its hand. As the New York session opened, we saw exactly what we were waiting for. Let's look at the dollar index chart first. See this zone right here. This was the critical resistance level we had marked. The initial push higher on the dollar after the data release looked strong, but it failed to break and hold above this area. We saw a long wick on that first 15-minute candle, which is a classic sign of rejection. Sellers were stepping in, and the buying pressure was getting absorbed. For me, that was the first major clue. A weak dollar is often a strong catalyst for gold prices to rise, as it makes the metal cheaper for holders of other currencies. This rejection on the dollar chart was the first piece of the puzzle falling into place. It shifted my bias from cautiously bullish on gold to actively looking for a long entry. Now, let's flip over to the gold chart. While the dollar was showing weakness, gold was doing the opposite. Look at this beautiful price action. It was consolidating just above a key support level we had identified around the 2,350 mark. This area had been tested multiple times in the overnight session and held firm. This consolidation, forming a series of higher lows on the 5-minute chart, was building up energy. It was like a coiled spring getting ready to release. The market was telling us a story. The dollar is failing at resistance and gold is holding strong at support. The probabilities were now stacking up heavily in favor of a move to the upside for gold. This confluence of signals across two different, but related, markets is what gives us a high probability setup. It's not just looking at one chart in isolation. It's about understanding the intermarket dynamics. So, with the dollar weakening and gold showing strength at support, it was time to define my entry. I wasn't just going to jump in randomly. I waited for a specific pattern. You can see it right here, a small breakout from this consolidation range on the 5-minute chart. The moment the price broke and closed above the top of this range, that was my trigger. It confirmed that buyers were taking control. I entered a long position with my stop loss placed just below the recent swing low inside that support zone. This is crucial. Your stop loss isn't just a random number. It's a strategic location that, if hit, invalidates your entire trade idea. In this case, if the price had dropped back below that support, it would have meant my analysis was wrong, and I'd want to be out of the trade with a small, manageable loss. Once in the trade, the next step is trade management. This is where many traders struggle. It's not just about getting the entry right. It's about maximizing your winners and cutting your losers. My first target was the next significant resistance level, which we had mapped out from yesterday's price action. As the price moved in my favor and approached that first target, I took partial profits. I always like to pay myself. This does two things. It locks in some gains, guaranteeing a winning trade, and it reduces the stress of managing the rest of the position. After taking partial profits, I moved my stop loss to my entry point. This meant the rest of the trade was now risk-free. The worst-case scenario was breaking even on the remaining portion, but I had already banked a profit. With the trade now risk-free, I could let the rest of the position run to see if we could catch a bigger move. And did we ever? The dollar continued its slide, and gold just took off. It sliced right through that first resistance level and made a powerful run toward our second, more ambitious target. Watching the price action, we saw strong. Impulsive green candles with very little pullback, indicating powerful buying momentum. This is the kind of move you dream of as a trader. We let it run until it started showing signs of exhaustion near the next major psychological level. Once I saw the momentum slowing and some bearish divergence appearing on the RSI. I knew it was time to exit the remainder of the position. We closed the trade for a significant profit, turning a good day into a great day. So, let's recap the whole process. It wasn't about a lucky guess, it was a systematic approach. First, we had a clear market thesis based on the relationship between the dollar and gold. Second, we waited patiently for confirmation from the price action itself, the dollar's failure at resistance and gold's strength at support. Third, we had a precise entry trigger based on a breakout pattern. Fourth, we used a strategic stop loss to define our risk from the outset. And finally, we managed the trade effectively by taking partial profits and letting the rest run in a risk-free manner. This discipline and adherence to a plan are what separate consistent, profitable trading from gambling. It's about putting the odds in your favor, over and over again. Every trade is just one instance in a long series, and the key is to have a positive expectancy over that series. I hope this detailed breakdown was helpful and gives you some insight into how you can approach your own trading with more structure and confidence. Understanding the why behind a trade is far more valuable than just seeing a green P and L statement. It's this process of analysis, execution, and management that builds skill and consistency over time. Remember, the market provides opportunities every single day. Our job is to be prepared, patient, and disciplined enough to capitalize on them when they align with our strategy. It was a fantastic day, and I'm grateful for the opportunity the market gave us. Thank you so much for watching and for being a part of this community. If you found this analysis valuable and want to learn more about our trading approach, make sure you hit that subscribe button and turn on notifications so you never miss a video. We're building something special here, and I'm excited to have you along for the journey. And don't forget, you can join me live tomorrow morning in our Goldroom Trade Live session, where we'll be doing this all over again. Analyzing the markets in real time. Until then, trade smart, stay disciplined, and I'll see you tomorrow.